right, thank you very much, Joshua. Eric, if you would just advance the first slide. We get to work off Eric's desktop today. All right, so that's me, Adam Halpern, up there in the corner. I won't be doing a lot of talking today. This is really Eric's area of expertise. However, I will be behind the scenes answering any questions you may have along the way. If I don't get to all your questions immediately when you ask them, please don't be offended. We'll get to them in the end. And if for some reason you just get missed, I'll definitely put our contact information in the chat box and you can ask us after the presentation. So just a real quick blurb, if you will, on Indicator Warehouse. If you are a NinjaTrader user, then odds are you've heard of us. In fact, if you haven't, then I'm not doing my job right. We've been a tier 1 partner of NinjaTrader almost since the beginning. And excuse me. And really our claim to fame was this thing called the diversified trading system. And what we did there is we took traditional portfolio management techniques and the methodology and we applied it to the intraday trading world. And so I'm not going to go into that right now. You're more than welcome to ask me about that either at the end of the presentation or head over to our website. Like I said, today's going to be all about Eric. I'm going to give you a quick introduction about Eric himself, how I met him and what he does for us. Eric, if you want to advance the slide while you're at it, you're welcome to. Eric was actually one of my first teachers. And so when I first launched Indicator Warehouse, we used to have hundreds of indicators, kind of the Amazon.com of the day trading world. Now, since that time, we've obviously been copied by plenty of other competitors out there, and that's fine. But what became very clear to me very early on is that yes, people wanted to build their own trading systems, their own toolboxes, but when they bought tools from us, they really wanted the Bob Vila of the world, of the trading world, to come with them. So I convinced Eric to come on board and be our lead moderator and trainer. He's a gifted orator and teacher, and kind of the rest, as they say, is history. So with that, I will hand it off to Eric, and like I said, I'll be in the background if you need me. Thanks, folks.
Bob Vila, well, those are big shoes to fill. Good afternoon, everyone. My name is Eric Senft, and thanks for joining us today. When Josh approached Adam and I about doing this webinar, we thought we would try to find a universal theme, rather than focus on a particular indicator or a particular set of tools. We thought we would focus on something that is a common thread among traders. Namely, why are traders losing money and what can they do about it? We've all heard the statistic that 90% of traders lose money, which means that 90% of traders are doing things wrong. And only 10% of traders are doing things right. But what are those things that the 90% of traders doing that is costing them money or preventing them from making money, maybe more accurate? Well, I think one of the problems, maybe one of the chief problems, is that 90% of traders are signal obsessed. Go to any forum, go to any chat room, read almost any thread that's related to trading, and traders are always asking about an entry signal. Whenever I show a chart and I try to demonstrate something, traders, they don't really seem to listen to what I'm saying. They're always asking, what are your moving averages? What values are you using for your moving averages? What values are you using for your RSI? And so on and so forth. They're obsessed with signal generation. They think if they could only find a good signal that they'll stop losing money. But as you're about to see, that is far from true. In fact, the subtleties are there that the signal generation, while important, is not the be-all, end-all. The good news is that you can join the 10% by doing what they're doing. So what are the three most common trading problems? I call these the silent killers because these are the things that traders rarely consider, if ever. First off, overtrading. Almost all traders overtrade. Secondly, money management. Most traders don't have a clue about money management, and we're going to focus on that a little bit today. Third, market mix. Few traders, if any, ever consider the markets that they're trading and the impact that they're going to have on their success as a trader. So these are the three things we're going to look at here today. Let's start with overtrading. Overtrading kills, as the headline says. Easily 90% of traders overtrade. That's the number one problem that I come across when I'm doing coaching and one-on-one mentoring with people, is that they trade far too much. Unless you're trading a huge account, and I am talking like several $100,000, most traders are trading far too much for their capital. And I think this all stems from a production mentality, right? If you're on the assembly line, if we can produce more widgets, we're going to make more dollars. If I do more, whatever it is I do in the non-trading world, if I'm a plumber and I do more plumbing, I make more money. But in the trading world, the exact opposite is often the case, where you can have too much trading and it's actually going to end up costing you money. So more trades do not equal more money. In fact, the probabilities decrease as your frequency of trading increases. Most people don't realize this, that the more often you trade, the harder it is going to be for you to find a profitable trade or to string together a series of profitable trades. In fact, it's much easier to find 2 winning trades than it is to find 20, and that should make sense. Every trade is essentially like flipping a coin. So that means that every trade, in essence, has a 50-50 outcome. Now I know there's the mathletes out there are going to take issue with this, but let's just take it down to the bare bones. Every trade is either going to be a winner or a loser. So every trade essentially has a 50-50 outcome. Therefore, if we take one trade, that trade has a 50% probability of winning, of being profitable. If we try to string 2 trades together, or if we try to flip our coin and toss heads twice in a row, the odds of doing that actually decreases by half. So whereas we started with a 50-50 trade, now we're down to a 25% chance that we're going to string 2 winning trades together. The odds of flipping your coin 3 times or getting 3 winners in a row again drops by half. It's down to 12.5%. The odds of 4 winners in a row down to 6.25%. The odds of 5 or more winners in a row drops to only, 3.125% of the time. So less than 3 times out of 100, you're going to be able to flip 5 heads in a row or string 5 winning trades together in a row. Now, I know there's exceptions. There will be times you'll take that quarter and you'll toss 5 heads in a row. But statistically speaking, that's only going to happen about 3% of the time, which is not a lot, obviously. You want to skew the odds in your favor. So how do we do that? Well, I think a very simple solution to the overtrading problem is to set a trade quota for yourself. And it doesn't have to be high. Again, you need to step away from that production mentality. As you're going to see, you can actually make a living on just 2 trades a day. How is that possible? And these don't need to be home run trades either. You can make a living on 2 $50 trades a day. The key is correct capitalization. By allocating the correct amount of capital to those two high probability trades, you will be able to earn all the money that you want, quite literally. So when you're setting a trade quota, I've already touched on this, less is more. You don't need to have, a trade quota of 10 days. I'll share a real quick story with you. A fellow came to me, I guess it's about a year and a half ago now, maybe even going on 2 years ago. He says, Eric, I want to hire you for coaching. I want you to teach me how to be a scalper. I want you to show me how to take 100 trades a day. I said, well, I can show you how to take 100 trades a day, but I said, you'll never be successful trading 100 times a day. Now, I know there's the high frequency traders out there, and I know they've got very sophisticated algorithms, and they're in and out of the market, 100 times a day, 200 times a day. But they have access to software. They're right next to the exchange. They have tools that as a retail trader, we don't have. So to try to scalp in and out of a market 100 times a day, the commissions are just going to eat you alive. And as you've already seen, the chances of being profitable on each of those trades dramatically diminishes the more trades that you take. So I'm a big fan of setting a low quota. As I've already mentioned, you can make all the money you want on 2 trades a day, anywhere, in my opinion, from 2 to 4 trades a day, depending on how the market is responding, is adequate. This gives you the luxury of being picky. How many times have you looked at a signal and something in your gut just says, gee, I don't know if I should take that signal, it doesn't look quite right, but you take it anyways and it turns out to be a stinker. Well, if you know you're only going to take 2 trades a day, you can afford to be picky, can't you? You can sit back and you can say, I don't like the look of that one. I'm going to wait for the next one. It may be better looking, and I'd like to see a little bit of a pullback or whatever, but you don't feel pressured to take a trade because you're only looking for 2 or 3 or maybe 4 trades in a day. So it improves your chances of being profitable, first off, because you're not over trading. You're not, chasing trades. And so long as you finish the day with a positive result, you will make money. Let's look at an example. All right. So let's say we're going to look at taking 3 trades here. And as is often the case, I don't know about your experience, but very often you get behind the 8 ball on that first trade, right? First trade, the market flashes you, it looks really good, you hop in, and it turns out to be a stinker. So let's say the first trade works out, you got a $300 loser. Second trade, you win $100. A third trade, you make $100. So now you've reached your 3 trade quota, but you still have a $100 loss. So we've met our 3 trade quota, but we have a negative result. So that means we need to take another trade. This is, of course, assuming we have a 3 trade quota on the day. So trade number 4, let's say it works out to be a winner and we have a $200 winner. Now we're $100 to the good. So we've met our 3 trade quota and we have a positive result. So we stop trading. We call it a day. We say, okay, we've met our quota. We have a positive result. Now it's time to call it a day. Now, $100 doesn't seem like a lot, but the secret is that once you can finish with a positive result, you can increase your earnings by increasing your position size. And we're going to talk about that in a little bit more detail in the money management section. But before we get to that, you don't want to go crazy when you're trading with a quota. Because let's say trade number 4 was a loser. Let's say you lost $100, now you're down $200. So you've met your 3 trade quota, you still have a negative result, so you take another trade. And you take another trade. Let's say for whatever reason, bad luck or whatnot, you can't seem to get to a positive result. Well, you need a safety net. You need a point where you say, okay, I'm done today, no matter how many trades I've taken. So you need like a pain threshold. Most people will have a fixed dollar amount in mind that, if they're down $1,000 or $500 or whatever makes you squirm in your seat, they say, okay, that's enough for today. There's something wrong with the marketplace. The markets aren't responding as I hoped they would, so I'm down X amount of dollars. That's my pain threshold. That's my safety net. I'm going to pull the plug. For me personally, I like a 5% max drawdown. So if I lose 5% of my trading capital in a single session, then that's it. I pull the plug on the day. My day is done. I know that 5% is an amount that I can recover from in a day or two. So it's not going to cripple my account. Something may not be, going on in the markets today that may just be too whippy or whatever the case may be, but obviously something is not working correctly that I can't make money today. So if I lose 5% of my trading capital, that's my safety net. I say, okay, that's it. I'm done. You don't want to be like these two people. I met two individuals, and this is a true story, two different people. One lost $20,000, one lost $25,000 in a single session. This was their entire account. They blew up their account. One had $20,000, one had $25,000 in a single day. How can you do that? Well, obviously you don't have a maximum drawdown that you're going to call it quits on the day, or you've allocated a certain percentage of your capital and you said, okay, this is my maximum that I'm prepared to risk in this single session. So don't be one of those people where you wipe out your account in a single session. It's important to remember that your job as a trader, you cannot make the markets do anything. Your job is simply to take what the market is giving you. If the market's not giving, well, then you're not taking. All right, very important concept. So you can learn from the pros when it comes to this. Most people be surprised at how infrequently professional traders actually trade. We all got this image in our mind of traders that they're like the guys in the pits, arms are waving and they're shouting and they're just order after order after order. Well, those guys are order takers, or they're arb traders. They're trading, for a tick here or a quarter tick, or in some of the stocks you can trade for what they call teenies, which is a 16th of a tick. But we can't do that as retail traders. What pros do and what you should do is you should focus on quality over quantity. Again, is that production mentality. Get that out of your head. You want to focus on odds. You want to know what is the probability of this trade working out. Notice I did not say risk-reward ratio. I'm talking about the probability that the trade will reach its profit target before it hits its stop loss. Remember, stop loss is not a loss if it doesn't get hit. Pros also know how to trade size in order to be successful. So they combine high probability, they control their exposure to the market, and they trade correct size in order to be profitable. All right, so how do you trade size? Well, that brings us to the subject of money management. 90% of traders never give any thought to their money management. Or if they do, they're thinking about it incorrectly. How do I know that? Well, because 90% of traders lose money. And again, of all the traders who have come to me for coaching or mentoring, 90% of them did not have a clue about how to correctly manage their trades. It's perhaps the best kept secret in trading. Money management is not risk-reward ratios. Risk-reward ratios are probably the biggest, well, I'm going to say lie for lack of a better word, but it fools traders into thinking that they have control over the marketplace. Professional traders calculate the risk-reward ratios, but only after the trade is done. Or they will adjust their risk-reward ratios as the trade is going on, depending on what the market is doing. Professional traders do not say, oh, well, I'll enter here and I'll exit here and I'll put my stop loss there so I can maintain a 3-to-1 reward to risk ratio. Why don't they do that? Well, because the reward side of the equation is the only part of that equation that you have no control over. You have control over your entry. You have control over your stop loss. That is the only part of the trade that you have any control over. So that brings us back to money management. That's your risk component, right? Your entry to your stop loss. That's your risk component. That's money management. Money management is never risking more than you can afford to lose. That is the key to money management. That is perhaps the key to successful trading right there. Because the math doesn't lie. Professional traders know that there's a very real possibility that they'll take 10 losing trades in a row. This is a statistical probability. I've gotten very close myself. I think my record is 8 losers in a row. But the key here is that you never risk more than you can afford to lose. Generally speaking, correct money management or professional traders will tell you that risking 5% of your capital or less is what you're looking to achieve. Now, if you're trading a really large account, like a $100,000 account, you can certainly get by risking a lot less. Shoot, you can risk a 0.5% or a 1/4%. If you're trading a small account, say like $10,000, okay, you're going to be skewed a little bit higher, but still try to keep it under 5%. Why? Well, if you take 10 losing trades in a row, let's see, 5 times 10, you're going to lose anywhere from 45 to 50% of your trading capital. But contrast that with what most traders do. They'll risk anywhere from 7 to 10% of their trading capital. Well, let's see, 10 losing trades times 10% of my capital. Oh, I've pretty much just blown up my account, haven't I? As a rule of thumb, 2% of your capital is considered the ideal. That gives you the greatest amount of staying power. In fact, you can make money with a 50-50 signal, risking just 2% of your trading capital. And there's a link there to the indicatorwarehouse.com/money tool, which is a great little tool that you can play with in your free time that will actually demonstrate that for you. So by risking 2% of our capital, if we're trading a $20,000 account, that means we're going to have a maximum risk exposure of $400 per trade. But what do the 90% of traders do? And again, I know this from personal experience, dealing with people, mentoring them, coaching them. Most traders risk far more than they can afford to lose, especially small account traders who will routinely risk anywhere from 7 to 10% of their capital. Well, it doesn't take too many trades like that to put a serious dent in your trading capital. The other problem that traders do in regards to money management is that they tend to strangle their trades. In an effort to maintain some sort of fictitious risk-reward ratio, they keep their stops overly tight, and then the market stops them out, usually just before it makes a run up to where their profit objective would have been. So again, by only risking a certain percentage of your account, you can actually maintain a decent stop. And I'm going to show you what this looks like here in a moment. And then, of course, the end result of that is that most traders do the exact opposite of what they should be doing. In other words, they lose big and they win small, when in fact you want to win big and lose small. I know it's very obvious, and yet Nobody does it. Why? Well, because nobody tells you how. Until now. The beauty is that managing your risk correctly will solve all these problems for you. Let's take a look at a chart. All right, so I know this is a little bit faint. I hope that you can make it out all right. We've got two charts here, identical markets, identical signal. The chart on the left is trading two contracts, and you'll notice the stop is down below that last swing low, and we have $360 at risk. The chart on the right has the stop a lot tighter. It's just below the signal bar. It also has $360 at risk. How is that possible? Well, it's possible because we are capping the risk at 2%. So regardless of where we place our stop loss, it's going to max out the trade at 2%. But can you see what the difference is? Do you notice the difference between the two charts? The chart on the left is only trading two contracts. The chart on the right is trading 6 contracts. See the quantity there where it says Q, Q6, and Q2? That's the quantity that you're trading. So what's actually changing is the profit is changing, because if we hit our profit target within the chart on the left, we've made $100. If we hit the target in the chart on the right, we've made $300 because we're trading 3 times as many contracts. But let me ask you this. Which trade do you think has the highest probability of success? Which trade do you think has the highest probability of working out? The chart on the left or the chart on the right? Well, intuitively, it's the chart on the left, right? Because it's got the bigger stop loss. It's got a lot more room for this market to chop around. It gives you a lot more time to hang in the trade, gives you a lot better chance of reaching your profit objective than the chart on the right. But the risk amount never changes. So regardless, if the market fell off the map, in both instances, our risk is capped at $360, regardless of whether we're trading 2 contracts or whether we're trading 6 contracts. Let's contrast that with what most traders do. Most traders lose big and win small. They say, oh, I'm a small account trader. I'm going to be careful. I'm only going to trade 3 contracts. So what have they just done? Well, they've locked in the number of contracts they're going to trade. Well, why is that a problem? Well, because you're no longer keeping your risk constant, right? In one instance, you may have $300 at risk, and the next time you may have $700 at risk, depending on where you place your stop loss. Therefore, you may end up risking much more than you can afford to lose. Not only that, but you may be leaving money on the table by not maximizing your winning trades. Let's take a look at an example. So typical trading day. This is the trader who says, okay, I'm gonna be careful. I'm only going to trade 3 contracts. I'm a small account trader. So let's say they trade 3 contracts and that first one works out to a $150 loss. Well, you've just incurred a $450 loss on that trade. All right, so you say you gather your thoughts and you're looking at your chart. Okay, you take your second signal. Let's say that one's a stinker too, and you took a $200 per contract loss. That's a $600 loss. So 2 trades in, you've got a $1,050 loss. So what do you do? Well, you say, well, I'd better be careful. The market's got my number today. I better stop trading 3 contracts. So you dial down and now you trade 1 contract. What happens? Of course, that one turns out to be a winner. Now you've won $200. You have a $200 profit, but you still have an $850 loss. What should you do? Okay, let's pretend we've got a $20,000 account and we're risking 2% of our capital. That means that the risk is capped now at 2% per trade. Now we're going to do the exact 3 trades that we just did. Trade number 1 is a loser. So we've lost our max. We've lost $400. Trade number 2 is a loser, but we're losing less because we're risking a certain percentage. So initially we risked 20,000, we lost 400. Now we have $19,600. So that second trade is a $390 loser. The third trade is a $200 winner. Now remember those charts I showed you a moment ago where one was trading 2 contracts, the other one was trading 6 contracts? Let's say we fell somewhere in between there and we took a 4 contract position. That would give us an $800 winner. So whereas the other 3 trades where we were keeping our number of contracts constant, or we started with 3 contracts and dialed down to 1 contract, we have an $850 loss. In this instance, we're pretty much at break even. And if we had set up our trade so that maybe we had 5 or 6 contracts in play, we would have actually been in a profitable position. Or let's say even if we had only traded 3 contracts instead of the 4, that would still be a $600 winner, and I've already incurred $790 in losses. So I'm down $190 versus $850. Exact same 3 trades. The difference is I'm controlling my risk and I'm maximizing my winners when they occur. So when I lose, I never lose more than I can afford. When I win, I maximize my earnings. Are you starting to see how important this is? How important money management is to your success? I cannot overemphasize this. The key to your trading success is to keep your risk constant. That means allocating a certain percentage of your capital. Combine that with adjusting your position size to reflect the risk amount. In other words, a bigger stop is going to require a smaller exposure. A tighter stop allows you to trade more contracts. But don't strangle your trades. Don't keep your stops so tight that the trade doesn't even have a chance to work out. But here, again, the beauty is that if you're risking a certain dollar amount and it's going to cost you $360 to keep a tight stop or $360 to keep a loose stop, well, why wouldn't you keep a loose stop? I know, it's a rhetorical question. And then, of course, if you combine that with not over trading, if you trade your quota, you can't help but be profitable. It's out there. When people first start to think about it, they have this aha moment and they say, no wonder I can't make any money trading. I've been doing it all wrong. Well, this is why. This is what you need to do in order to maximize your earnings and minimize your losses. Now, the good news is there's actually software that does that for you. Indicator Warehouse has a tool called the Trade Manager that automates this entire process for you. In fact, when Adam first told me that what he wanted done, that he wanted to develop this piece of software, I said, I don't think you can do it, not on a retail level, not for the personal computer, because this is the kind of stuff that they have on Wall Street. This is the kind of stuff where they have this mega computer that, takes up the size of an office, and it does all this for you. And yet, Adam pulled it off. He got the right programmers together, and he has this tool called the Trade Manager that caps your risks. It automatically adjusts your trade size for your risk exposure. It never allows you to risk more than you can afford to lose. And it allows you to maximize your earnings on your winning trades. It's quite literally everything you need to do to make money trading. It also comes with the some automated stop strategies. There's 16 different stop strategies to help manage your open positions, and they're all fully customizable. So just a quick little look at the Trade Manager. That's the tool that you see there on the right margin of the screen. The bottom arrow is pointing to the Risk Manager component of the Trade Manager, and you can see I've got my risk capped at 2%. So that means no matter where I place my stops, I will never have more than 2% at risk. The blue dots that you see trailing in that chart there, that is the Profit Manager component. That's the trailing stop, the auto stop. And that will help, if you don't know how to manage your trade correctly, you've got 16 stop strategies to choose from, and they'll help you stay in a trade as long as you want. All right, the last component that traders rarely consider is market mix. 90% of traders never consider their market mix. And I wrote there, did you? Be honest, because if you're honest with yourself, probably no. You're trading whatever seems sexy, whatever seems popular. I see it all the time. People trading markets like the 30-year bond, or crude oil, or natural gas. And their accounts, they're trying to trade natural gas with a $10,000 account, and it's like, you're crazy. You can't do that. Well, my friend does it. Well, okay, well, your friend's trading a $75,000 account. The markets you trade will have an impact on your profitability. Why? Well, because of the tick size. The tick size makes a huge difference to the number of contracts that you can trade. Ideally, you want to trade multiple positions. Why? Well, because multiple positions give you options. If you've ever traded a single contract on a trade, it's always the ongoing debate when you hit your profit objective. Should I take profit? Should I try to run it out? What should I do? Well, if you're running multiple contracts, you have options, right? If you're running at least 2 contracts, well, I'll take profit on one. I'll try to run the other one out, see if it goes higher, and there's more options available to you. So multiple positions are easier to manage. But in order to do that, you're going to need to trade a market that enables you to trade multiple contracts, which means focusing on the markets with smaller tick values, which unfortunately are not usually the sexy ones. Case in point, the E-mini S&P versus the NASDAQ. Everybody loves the E-mini. E-mini's sexy, right? You're standing at the cocktail party, you're wanting to show off to somebody, oh yeah, I'm a day trader. I trade the E-mini S&P. Wow, E-mini S&P, I've heard of that. Well, the E-mini trades at 12.50 a tick. Well, what if you looked at trading the NASDAQ or perhaps even the mini Dow instead? The NASDAQ trades at only $5 a tick, as does the mini Dow. The E-mini is more popular, but is it more profitable than trading the NASDAQ? Well, most people assume that bigger tick values means more profit, but is that the truth? Traders assume that the markets move the same number of ticks. Therefore, if the E-mini moves 10 ticks, well then the NASDAQ must move 10 ticks, right? Therefore, if I'm trading the E-mini, which is worth more per tick, I'm making more money. Is that the truth, though? What most traders don't recognize is that sometimes the smaller tick markets actually offer you bigger opportunities because the markets tend to move an equivalent dollar amount, not an equivalent number of ticks. Therefore, if the E-mini S&P moves $100, then the NASDAQ is also likely to move $100. Now, this isn't carved in stone. They don't move lockstep with each other, but this is an approximation. Sometimes the NASDAQ will move $140. Sometimes the NASDAQ will move $80 relative to the $100 move in the E-mini. But by and large, if the E-mini S&P makes a $100 move, the NASDAQ or the mini Dow will make a $100 move. But as you've seen, we can trade more contracts if we trade the NASDAQ. right? The NASDAQ is $5 a tick. The E-mini is $12.50 a tick. So we can trade at least 2, and depending how we set up the trade, sometimes 3 contracts for each E-mini contract. Therefore, in the NASDAQ, we have the potential to earn 2 or maybe even 3 times more money than the E-mini S&P. Even if the NASDAQ came up a little bit short, let's say the E-mini makes a $100 move, the NASDAQ makes an $80 move. Well, I can afford 2 contracts for every 1 contract I can trade in the E-mini. So if the E-mini moves $100 and the NASDAQ moves $80, but I'm trading 2 contracts, I've made $160 versus the $100 in the E-mini. Now again, this isn't carved in stone. They don't move lockstep, but it's something for you to consider. So when you're looking at your market mix, some considerations when you're looking at these smaller markets is, do they have adequate volume? Do they have adequate volatility, especially if you're trading intraday? You know, you don't want to look at a market like, well, you probably don't want to look at a market like oats anyhow because they don't move enough, but you need a market that has got adequate volatility and adequate volume. Also, you want to make sure you get decent follow through on the signals, right? You just don't want to be chopped around a little bit. You don't want to have to ride out a trade for hours on end before it finally creeps up to your profit target. And you don't want to follow too many markets. People get, again, the production mentality. Well, if I follow 5 markets, I'll make more money than if I follow 1 or 2. No, no. Most markets tend to move together anyways. No, no. Most markets tend to move together anyways. The NASDAQ and the E-mini tend to move together, as does the Dow, as does the Russell, as does the DAX or the Stocks 50 or the mid cap. You know, all the stock indices will move more or less the same. So you don't need to follow a lot of them. What are my favorite low tick value markets? Ones where I think you get the best bang for your buck? The NASDAQ, the mini Dow, and the Spider. The Spider is an ETF. It offers you the ultimate in position size flexibility. You can quite literally trade the NASDAQ, or pardon me, the Spider for less than $1. But why you would want to is beyond me. But that option is there. You could trade a single share of the Spider if you wanted. All right, so there you have it, folks. The 3 things that you can focus on right now to improve your trading. And it has nothing to do with your entry signal. The question now is, are you prepared to do what the 10% are doing? Are you prepared to stop overtrading? Are you prepared to do correct money management? Are you prepared to take a look at the markets you're trading and look at those relative to your account size and say, hey, maybe, you know, maybe I'm not cut out to trade crude oil or the E-mini with my small account. Maybe I should be focusing on the Spider or the Dow or something like that. Here on the slide here, I have what George Costanza taught me about trading. George Costanza, of course, the character from the Seinfeld series. There was one episode where George decided to do the exact opposite of what he had been doing. His logic was that if what he had been doing up to this point in his life brought him to where he is now and he didn't want to be there, then by doing the exact opposite of what he was doing, he should be going somewhere else, somewhere where he really wanted to be. And so the whole episode started with him ordering a different sandwich for lunch, and by the end of the episode, he was manager of the New York Yankees. But, you know, it was all done tongue-in-cheek, but there's a lot of truth to that. If you keep doing what the 90% of the traders are doing now, if you keep being signal obsessed and focusing solely on, you know, tweaking your indicator or adding this shiny indicator or that, thinking that if you could just find the right signal, you're going to be a successful trader, you're going to continue to stay in that 90% of traders that lose money. So I realize that some of these concepts are foreign to you. Some of the concepts are new, but I encourage you to, give them a little bit of thought. And I think you may find that some of these things may actually end up working for you. Now, if you've managed to stay with me this long, we do have some thank yous for you. As Josh already mentioned, there's a couple of reports coming to you from Indicator Warehouse. There's also, today only, we're making available the How to Day Trade Crude Oil Manual from the supportandresistance.com website. That link will only work for today, so it's only for those of you who have actually attended today's webinar. It normally sells for $49.95, but it's yours free as a thank you for your attendance. And then from Indicator Warehouse, there's also a special report, an easier way to trade, and access to the Indicator Warehouse trading room, so that you can see how some of these tools work that we demonstrated here today. So you can see how the trade manager works and how the DTS system works as a signal generation tool. So you can see how we tie all these things together, hopefully to make you a more successful trader. All right, well, that's it for me. Adam, I'll turn it back over to you. And thank you, everybody, for your attendance, and I hope that you found it at least a little bit helpful.
That was awesome. So, so thank you, Eric. Eric was definitely spot on today. I was getting a lot of comments, while Eric was talking about what a great teacher he is, and I could not agree more. And now having been, excuse me, doing this for like 7+ years and seeing all the different interesting players in this space, I've come to the conclusion that having quality products, software products, that's just the price of admission. It's having quality people on your team supporting our customers. That's really what sets a company apart, and I'm proud to say Eric's one of them. If you end up working with us, you'll also meet Ben. Ben heads up the support department. Again, just a stellar individual, excuse me, who goes the extra mile. So let me just check real quick for any questions. I don't think I missed any along the way, but first of all, thank you to everyone, for the compliments, awesome, etc. So Eric, could you review the impact of a big stop versus a small stop vis-a-vis adjusting the position size? How does that impact the position size? You still with me, Eric? May have dropped off. Hang on a second here. Give me one sec. Eric? Yeah, you dropped off. I wanted to put this slide up earlier because the real thing that Eric learned from George Costanza is to work with intelligent, bald men. So, no, couldn't resist that. Anyway, let me, so this recording is, or this has been recorded for sure. Let me give you Eric's contact information. Okay. And here is my contact information. And I want to let you know a few things about the trade manager. It's important. I get this asked all the time when when people call in and ask about the diversified trading system. So one of the things that was key when we developed the diversified trading system, among the other tools that we have, is that they must work not only to enhance DTS, but also enhance anyone else's system and or be a standalone product in and of itself. So Trade Manager, perfect example of that. You do not need to own DTS in order to take advantage of the Trade Manager, which is the position sizing and an automated trailing stop tool. So I get asked that a lot. It can absolutely be purchased separately because oftentimes, if you have a signal or a system that's working for you, I'll be the first to say that, don't throw out the baby with the bathwater. You don't have to use DTS. It's if you're looking for a signal system, signal generating system, then yeah, that's a discussion to have. But sometimes all people need, is a good money management tool like Trade Manager. The other thing you'll notice, not just about our products or DTS, Trade Manager specifically, is we try as we intentionally design our software to be as simple to use as possible on the surface. Because of my software background, I've always believed that user design is key to being able to use that software correctly. So yes, of course, Trade Manager is now in version 5, very mature product. Are there copycats out on the market? Of course there are, right? That just happens. In fact, I think one launched today. What you need to be looking out for is, I'm sure there's a lot of good software out there. Is it designed for the real trader? Is it something you can use like you wield a samurai sword, right? Is it easy to pick up and use immediately and give you value? Or was it designed by, programmers or engineers and, you need a PhD to actually understand how to use the darn thing? So it's a key thing to remember just when you're looking across the board at any of the vendors, but particularly when you look at what we have to offer, because that's always a key element when we go into design trading tools. The other thing I want to bring up, because there's a lot of times people, they don't understand or don't know about what makes our trading room or trade room unique. So when we say free access, we make our private members-only trade room open to the general public every Wednesday. You can come in and you can see Eric using our tools. He's the trade room moderator. Obviously, if you've been on this presentation, you know he's a gifted presenter. And the way our trade room works is if you invest in the trading system in DTS, you get the trade room for life for free. So we don't believe in basically forcing you to continue to suck from the teat, if you will, and stick with us just because you need access to the trade room. Our feeling is if you make an investment into our trading system, then you've earned the right to be taught how to use those tools, and you are welcome to stay in the trade room as long as you want. It is not a call room, right? So we didn't design it under what I call the monkey trader mentality, which is, hey, I'm an amazing guru, pay me money, and you can watch me trade and pretend that you can copy me. It just doesn't work. So our goal with that trade room, quite frankly, is for our customers or our clients to leave the trade room, because it's our understanding that people get into this business to be independent, self-directed traders, not to sit there in a trade room for the rest of their lives. So it is a training environment in which Eric trades live in the in a live market, but it is there as an educational venue for you to learn how to use the tools that you have purchased from us. Now, one of the other interesting things we do is if you purchase any system add-on tool, of which Trade Manager is one of them, you are also entitled to come into the trade room for life. Again, there's nothing secret going on. There's no such thing as secret trading. That's silly. And so, our belief is come in, see how the tool that you purchased is used, and you're welcome to see how the other tools are used. And this really helps for individuals who want a trial or a demo. This enables them to come in and see how these tools work day in, day out without being forced to restrict themselves to a 7 or 30-day trial, which again, I think creates an unnecessary stress. So anything else? Hopefully I've addressed everything, but if there's anything else I can cover now, please let me know, and I'm happy to address. Hang on a second. TK, could you email the above info to us, please? Josh, if you're still on the phone, if you can email them our contact information, I'm happy to do that. You're welcome to share our contact information. One more note: the trade room action or the trade room trading session, we post that private session every day to our YouTube channel. And so really the primary advantage of being in the trade room is that you have the luxury of asking questions of Eric live, but if for whatever reason you're not ready to make that kind of an investment or the timing's wrong, you can always find the recordings on our YouTube channel. Let me get that link for you. Hang on one second. And, oops, sorry, hang on. Let me try this. There we go. And so in the trade room, not only will you see daily recorded sessions of the private trade room, you'll also see training around Trade Manager and some of our other premier tools. If you're a NinjaTrader, there's some tips and tricks for using NinjaTrader. A variety of things. We've tried to make that YouTube channel as organized as possible, and it's very useful to basically just get a better sense of what we do and what makes us unique in the marketplace. All right, look at that, 4:29. I'm such a, I love ending on time. What is the link to the Trade Manager? Good question. You know what? Let's see. The best thing to do actually is if you go to our homepage, which I just put in there, so indicatorwarehouse.com, you'll if you click on the link that says Trading Indicators, you will then be sent to different kinds of indicators that are out there. One of which says System Add-ons, and in the System Add-ons section, you will find the Trade Manager icon, and I recommend you link, click on that. I think, hang on one second, give me 1 second, I'll actually get you the exact link. If you just give me one moment. Here. Okay, so there you go. Oh, Eric brought up a good point. We do have a search box there for a reason, so you're welcome to use the search box for that. On the Trade Manager page, you'll see another really good demonstration, explanation, if you will, from Eric talking about money management. Some of the same principles that we covered today, but going into more detail. And so I highly recommend you spend some time there. There's just valuable information whether you end up purchasing the trading tool or not. The presentation is excellent. All right. Anything else? Great. Okay. Well then, as I said, if you want to join in on the trade room, join us every Wednesday. If you go to the home page, you'll see a link right at the top that says Free Trade Room. Click on there, and you can register to join us on Wednesdays. There's also a very interesting trader personality test. If you have some time, I recommend you also take that. It gives you some good insight into what kind of a trader you are. Everyone, all the newbies always think that they're scalpers, and you'd be surprised about how few people really have the personality to just be a scalper. It takes a certain mindset to do that correctly, and most people don't have it, and therefore they get chopped up rather quickly, or even worse, a very slow, painful death. So thank you so much for your time. Joshua, I'm going to hand it back to you, and always a pleasure to come and talk to the Trader Kingdom crowd, and we'll hope to see you again. Thank you.